Okay, hello everybody, and welcome to Investing with IBD for January 8th, 2020. I'm your host, Arusha Pierce, and with me in the studio today is Mike
your
Webster.
very best friend.
I can't even say your name. You're interrupting me. I can't even say the name.
Dude, it's going to be a long podcast, man. It's going to get worse.
Mike Webster's in the studio, IBD's head market strategist, and also in-house interrupter.
Yeah, if anybody drinks at home, what you need to do is watch this on video, right? And every time Arusha doesn't smile, you take a drink. You're going to be sober.
Okay.
That's, I'm just saying.
I was going to say thanks for being here, Mike, but...
Oh, sorry.
No, thanks for being here. We're all excited to hear your thoughts on what's going on in the market. So on today's podcast, we are going to talk about the current markets. Then we will go over post-analysis, a critical exercise that we all need to do every year. And we will end the episode with 3 current stocks. So let's get into the current market. Maybe 4. We might have a bonus
stock. If you
stock.
can keep me going fast, then we'll do 4.
And that's not going to happen. That's definitely not going to happen.
Maybe we'll do 1 stock. I don't know.
So let's go with the current market first. Mm-hmm. We are in an uptrend, a confirmed uptrend. We've been for the last couple of months, 2-3 months now. 3 distribution days on the S&P, 2 on the Nasdaq. This is a bull market. This is a classic bull market, right? Climbing the wall of worry.
And this week, right?
Do you want to talk about worry?
Oh, man. Like last night, I mean, that was stressful.
It was funny because last night, once I started seeing on Twitter, it was like, it was an hour after we spoke or something. All of a sudden, everything.
It was right after we
I only found out an hour. Yeah, because thanks for telling me about it. Right? Mike and I were talking maybe 5 minutes before the missiles were launched. And then Mike goes to his desk. I go home, and Mike doesn't tell me, and I only find out.
Well, that's because you said we weren't best friends.
That's true.
If you would have said that, I would have been like, "Hey, Arusha, this is what's up, man. Bad stuff is happening."
I almost texted you too. I almost said we might have to throw everything out that we talked about, and talk about what to do in a kind of a crisis, and be defense now and all that.
So this was a great lesson, right? So we right after the close, or a couple hours after the close, we have the Qs and the futures just falling like a rock, right? And so what do you do in that case? You really don't do anything, because trading in the after hours is something that you would only do in a very rare events, and in the middle of just headline news where you don't really know what's going to happen. It's a recipe for disaster. So I did nothing but stressed a lot because I was starting to get I came into the year light. And we'll talk about that a little bit later. And then I was starting to get a little bit more concentrated, which means for me these days from 40 stocks to like 22 stocks, but heavy in the market. And then all of a sudden this news comes out. I'm like, oh God, back to the drawing board.
Now let's just be clear with the news.
Yeah,
Iran.
You go ahead.
Iran. Launched 12 missiles?
I think it was 15.
Was it 15?
Yeah,
okay, 15 missiles towards Iraq, towards a number of the bases where U.S. troops were housed, and when that all was happening, they hit all around those areas. No one knew how many casualties, all this stuff. So it was very, very scary, and. Yeah, it's kind of.
Didn't your heart just go out to the imagine if you're the family of people that are stationed there, it's just so heavy. Then throughout the night, then once President Trump put out his tweet that all was well, and then that at that point there were no casualties. Right. On multiple levels, it was feeling much better because one, most important, that no one was dead. And I don't know if anybody got hurt, but no one died as far as we know at this point.
Which is really amazing, actually.
It is. And it says something about how great our military is. I mean, we really do have the best military, but still, anything can happen, right? And then from a market standpoint, so you kind of have to take off your humanitarian hat and put it aside and say, okay, with the market, what's going on? So the fact that he wasn't put in a box where he was going to have to come and retaliate, and then they were going to come back. It's kind of like gang members as they drive by. Someone does a drive-by shooting, then the other gang has to do it, and then in the end, just you got a lot of death, and we just didn't want that, and so it was allowing things to de-escalate, and that's what we saw today with the press conference where he came out, and whether you love Trump or hate Trump, very presidential, and gave Iran an out to just kind of mellow and step back and now we can kind of move forward and think about earnings and everything else and not have this hanging over us as much as it was last night. We could have started World War III.
Yeah, but even before this, right? Even last week, when the news is starting to escalate and tensions were starting to really escalate, the market was shaking off a lot of that news, right? We had the gap downs a couple of times. Market would come back, gap down, come back, and all these growth stocks that were all looking forward to buying, they kept making new highs.
Well, that's what, going back to your original statement about being in a bull market, and I think back to Livermore's book, the Reminiscence book, where, the old guy says, we're in a bull market. We are in a bull market, and you can't forget that. And you have to treat things differently. And so you err on the side of being aggressive, being invested, because we're in a bull market. Bear market, different. If you're not sure where you're at, completely different, right? Because that's a chop zone.
Right, exactly.
You like the chop zone.
The chop fest.
I'm sorry. But anyways, so let's look at the NASDAQ itself in this channel that we're in.
So for those of you want to go to investors.com/podcast, when you're back at your computer, so you can see some of these channels that Mike has drawn on the NASDAQ to give him an idea of where the market could change or the health of the market, right?
Yeah, so it's really helpful when the market gives you an expectation. So right now we have this clear expectation that everyone can see this channel that I've drawn here. There's nothing magical about it. The first year of looking at charts, and you can say, okay, we're in this kind of tight, uptrend, and then you just draw some lines on it, and you see, okay, we're in this area where you can expect to stay in it until you're not in it, and you can stay in a channel a lot longer than you would think if the angle is realistic. If it's unrealistic, like we had last January, where it was kind of straight up, that wasn't going to last a long time. This is kind of pushing it. It's very,
January 2018.
2018.
Yes.
Oh, I'm sorry. Yeah.
So January 2018. Exactly. Yeah. It really started off really strong. I know a lot of us were up double digits in that first month. Yeah. Right. Their portfolios, and it's just like that's not sustainable, unfortunately.
In going back and studying that time frame, what I've found helpful is if you draw a bottom channel line, like I have here, your blue channel line, and you ask yourself, is this sustainable? And if so, for how long? And that one back in the January of 18 was, that was not going to happen.
Right.
It
like
would
a 60-degree angle.
Yeah, you're not going to be able to sustain that. So you can trade it differently. And the next time we're in that type of environment, I'm going to trade it differently too. Yeah. More cautious, still in, stay with the trend until it breaks. So the problem we have now is we're bumping up against the red channel line on there. We don't
Which
want
is the upper channel
the
line.
upper channel line.
Right.
And you can go up above it a little bit, but you'd rather stay in the zone, because then it's getting a little carried away. And so what it was nice about this news, putting any bad stuff, just completely compartmentalizing that, it allowed us to kind of go sideways a little bit with the market. And at the same time, growth stocks are just kicking butt, man. They're just breaking out all over the place, whether it's from normal bases or alternative pivots. And you've got strength in cloud stocks again. You've got it in retail, all over the place in chips. Even some solar stocks. I mean, it's really broad based.
It is. And so now let's just quickly switch subjects.
Sure.
Let's just talk about how you approach the new year.
Oh, yeah.
Right. Because you do have a certain way to approach the new year. And so why don't you share that with us?
Yeah. So, I've had some tricky Januaries where, I was coming in to, if you have a good last quarter of the year, you're heavy in the market, you're on margin, what have you, and then all of a sudden the calendar shifts and it's January, and if your account is off 2 or 3%, and it just all your stocks look normal, and the market looks fine, but now you're underwater, and it completely changes your mindset, right? It shouldn't, but a year-to-date percentage is it's one of those things you want to do everything in your power to guard yourself off of being down, and certainly down more than 2%. Once you get down more than 2%, this has happened to me way too many times in my career, then the 2 turns to 3 to 4, and then it becomes quicksand, and you're just psychologically it is completely different. You're trading not to lose rather than trading to win.
Yep.
And I haven't figured out how to battle that out when you're down. It's just it is very, very difficult, and it's very difficult for me. So you want to guard yourself against that and don't put yourself in that situation. So I'm coming into every year light. And the worst case is you're playing catch up where you're flat or just up a little bit and the market's up a bunch. So, but also with Bill's teaching, what he would always teach us to do is it's okay to have a theory, but go back and test it. Mm-hmm. And so I just did, my, overkill type of thing, and I studied every market, the last 2 weeks of the year, the first 2 weeks of every year. And I found that in the beginning of January, all of a sudden you get stuff out of the blue that it just falls. And, everyone should go back and study that. And so there's something to be said for taking it light into January. Bill would always say if he was ever going to take a vacation, I never saw him take did you ever see him take a vacation?
No.
That he would do it in January because it's tricky and everything.
Which makes sense, yeah. So now let's end the segment with an update on the major bull market that you spoke about. It's on a Mark Smith webinar back in September of 2018 that we did, and that's where you introduced this concept on your research, really just so let's get an update on that. You were comparing the market from 2016, and the last few years before that to the 1949-1966 market, and we were just starting back then in 2018, what you were saying is we were just starting a brand new major bull market, which is multiple bull markets.
Yeah. So we obviously don't have the time to get into it now. I did probably an hour and a half on this subject back at the level 4 last year, not this year or the prior year. And we did something on a podcast, or not a podcast, it was a webinar.
It was a webinar. That was September 2018. So
on Market Smith, right?
Yeah. So those Market Smith members, we want to go and take a look at that because that was a really good intro.
Yeah. So we did about 15 minutes on it. And essentially, in a nutshell, is that 1949 lines up with 2016, July of 2016. And then you have this long... there's this long thing behind it, but the real question is those people who know what I'm talking about, and you will once you watch the webinar, are we still in that major bull market? And yes, we are. And so on this monthly chart on the Nasdaq, I've drawn the channel, or not the channel line, but the trend line that you need to use to see if we're in it or not. And in the fourth quarter bear market that we had
last year,
the prior year, that we actually broke through it,
right?
Which was fine because precedents are made. You have to be flexible with it. And at that time, I said, okay. That now what it was telling me is if we don't go back through here, that we're going to be in a sideways market.
Yep.
But if we go through it, back up through it, which we did, which you can see on the chart there, then you need to be aggressive and push hard. And that's exactly how last year played out. And that's why we do the research. You do your research, I do my research, and we share it with everyone. And so as long as we stay above this, the major bull market is intact. If we come back down and test it, as we come up from there, that's where you want to press hard.
Perfect. Yeah. So that's the update. So we're still in it. The president is still working, and so you want to keep that in the back of your mind. So the indices, they continue to climb that wall of worry, and yes, we are in a strong market. Let's take a quick break, but when we return, it's about that time of year when everyone wants to exercise.
I don't want to do this.
Right? And we're going to talk about a painful exercise that every stock investor needs to do.
I'm not doing push-ups. Okay, post-analysis. I'll do that.
Stay tuned. Hey, Arusha here with a big announcement. We have launched a brand new interactive video broadcast called IBD Live. IBD Live takes you behind the curtain to see how professionals trade. Log on and watch live as IBD's analysts and portfolio managers follow the first hour of market action and pick winning stocks. You get to listen to our conversations, see our screens, and ask us questions all in real time. If you've ever wanted to trade alongside a team of experts, this is your chance. Go to investors.com/IBD Live and sign up to get your first 2 weeks for free. Mike Webster is our guest on Investing with IBD. Okay, Mike, let's get into post-analysis. And this is a tough topic for everyone, or at least maybe just for me. Because it's hard to look at. Man. Yeah, it's hard to look at your mistakes, right? And look at all the dumb things you've done the previous year. But last year was a great environment for our kind of style, right? But it was a tricky environment too, right? So it is a perfect time to go back and learn from those mistakes, because we're going to be in another environment like that. Who knows if it's this year, but in another few years, well, there'll be another great environment where these stocks act really well, and so you want to just get better so you can capitalize on it even better the next time.
Yeah, absolutely. And then sometimes there's good environments and you just trip, you got to get yourself up, dust yourself off, look back and say, what did I do? Why did I trip? And then sometimes it's a difficult environment, but you're just kicking butt, man. You're just like, you're in the zone. So the goal of doing a post-analysis is saying, how can I get in the zone and stay in the zone? And when I'm out of the zone, what do I do? And so, we do this here. Every year we go and do a post-analysis. And talking about this, when we were talking yesterday, excuse my cough. When we were talking yesterday, I brought up Genesis Microchip, which I tend to always think of when you say, well, we're going to do a podcast. I'm like, yeah, cool. And I'm like, what do you want to talk about? You're like, post-analysis. I'm like, well, maybe not so much because it's boring. But Genesis Microchip was one of my first main lessons that I learned from a post-analysis, and this was back in 2002, and I had mishandled Genesis Microchip. I didn't lose money on it. I might have lost 1% or 2%, but I had this missed opportunity and really messed up, and I was in Bill's office at the time. I had spent a couple of years in his office. It was wonderful. Just priceless learning experience. Yeah. But he was not happy with how I handled this stock. He let me know. He's like, Mike, you need to go do a post-analysis. I'm like,
so on investors.com/podcast, we'll show this chart, but it broke out of a double bottom. Yep. It went up on a really good run, maybe 70% or so, 80%. From that double bottom, and then the first chart we're showing, then it's breaking the 50-day moving average on heavy volume first time.
So it had the power from pivot, and so this, for those of you who don't know, this was the chip behind the flat panels, and so this is at the beginning when we all had the CRTs. Anyone who
heavy.
Yeah, on the younger side, it's what your grandparents had, or what we had, right? Or projector TV. I had this cool projector TV, right? But I could see this. I'm like, oh my God. I was so convinced. I'm like, this is the way of the future. We're going to all have flat panels. Only the really, really rich had, a couple flat panels. But now everyone has, you'd have to probably pay up for a CRT and get it in a museum or something. So I saw this shift, and there's a lot to learn from this, because you can see a shift and be ahead of the curve. People weren't really talking about it because at the time it was too expensive, blah, blah, blah. But you could be wrong on the stock or wrong on the timing of the market. Yeah. This was a great bear market, 2000 to 2002, right? Yep. And this was in the middle of it, and we had a follow through, and the market was strong at this point we were trading. So I had this thesis on, this is going to be a game changer. It was. This was going to be the stock. It wasn't. It broke out of this base. I'm buying it. I keep pyramiding into it because I'm thinking in my head, my idol is Bill O'Neill, and I want to be Bill, which is a very important thing. Is don't be Bill O'Neill. Be Arusha. If you're Arusha, be Mike. If you're Mike, and whoever it is, be yourself. and trade it the way you want to trade it and how you think. And so I'm in this thing, I'm up to my eyeballs, pyramiding up, I'm like, having a great old time. Then up at the top, it builds this shelf thing. And if you don't know what a shelf is, then you're not listening to IBD Live, right? So it's this little thing that's not a base and it's not necessarily 3 weeks tight, but it's pauses.
So that's around the 70 level.
Yeah, around there. And it breaks out and it goes higher. So I'm adding to it, which is what I would do again. Now, at that same time, the market stalled and started coming down. Okay. And this is another learning lesson, that you need to pay attention to the market even if your stocks are doing well. So everyone around me who wasn't in this was like licking their wounds. It was a really bad day. And I'm like, well, it felt good to me because my biggest stock was up. Yeah. So pay attention to what the market's doing regardless of what your stocks are doing. So that was the first lesson that I learned. I think that was January 9th, 2002, but who's counting? Not like it's seared in my memory. And then it comes in a couple days later and comes back into the top of the shelf. And what I learned after studying this was if that happens, so you buy it, you're adding to it as it's going through the top of the shelf, fine. I do that all the time, a lot actually. If it comes back in, it's breaking your expectation, sell at least half. Sell at least half at that point. And if it comes in further, blow out everything that you bought there. Yeah. And that's what I should have done, and actually thrown in the towel at that point. I waited for it to break the 50 and blew it out there. So I'd round-tripped, pyramided too much. And at that point, that was what I learned from this. And I went back and studied every other trade, and Bill had said, do a post-analysis. And so the other moral of this is keep it simple. So what I did is said, you know what, I have got this idea. That's this great idea, let me clue you in.
And this was the first time he asked you to do a post-analysis?
First time he asked me, okay. Yeah. Not nicely. Well, no, nicely. Well, you can take it however you want. So anyway, he asked me to do the post-analysis. Yeah. So, in the end, I hadn't lost money. I just gave back a lot of profit, so that it could have been worse. So at that point, I go back and I say, you know what, I'm never going to let this happen again, and I'm going to be very methodical. And I wrote out this plan, and it was page after page after page with X happens, then I'm going to do Y, and then so on. And before you knew it, I had 18 pages of gold, man. This is good stuff. I'm like, Bill is going to be so proud of me, And if you stub your toe on Tuesday, I had a plan for how you were going to attack that. Like every last thing was in there. And I go to him. I'm like, hey, Bill, I figured this stuff out. And
he gave an 18-page document.
He's like, what? What are you doing? 1 page, Mike, 1 page. And I'm like, oh my God, I spent all this time and figured out all this stuff. But what he was trying to tell me, and sometimes with a little, when you can step back and you've got actually decades really of space between it, he was saying, keep it simple, Mike, that don't have 18 pages of rules. Now, that might be something great to have as a different roadmap. It was really solid. I'm going to dig it out and probably use it. But if you've got a problem, just keep it simple. And the simple thing was don't pyramid too fast, don't pyramid too heavy, pay attention to the market. And if you've got a sell rule, use it. Now, I didn't have the sell rule at the time, but now I have that, and just follow that. And what he would say is keep it on 1 page. And then after that, in prior years, when he would ask me to do a post-analysis, he would actually say only come up with 3 things. Yeah. So that way you're not making tons of changes on your trades. If you try to make 18 pages worth of changes on your trades, the good stuff you were doing might get thrown out. Right? And so just keep it simple. Is that how you do it?
Yeah, I definitely believe in the simplicity. And the simple reason why is every market is going to be different, slightly different. And if you're too rigid in a lot of stuff, right, you're not going to be flexible enough to adapt to that environment. Yeah. And so that's what I've just learned. So I think I had tons of rules in the beginning, and now it's very, very simple.
Yeah, the simpler you boil it down.
Because it enables me. If for instance, and we've spoken about this. I think we went over this in IBD Live, but I've always talked about this. Is when you learn about these bases, you want to make sure it's U-shaped enough. It has to be beautiful and all that stuff, and that's very, very important. So don't mistake this. But if I see a company that has a great story to it, and its base might not be that great looking, right? But it breaks out, I'll still take a chance at it.
You're talking about Cuba.
I could. I did. Yeah, Kuba was one. Shopify was one last year.
Yeah.
And Viva was also one last year.
Yeah.
They were terrible bases.
Yeah, they really were.
Yeah, but they broke out. I was like, I really like these stories. I'm going to take a chance and see what happens. And so as long as the stock acts perfectly afterwards and it acts like it's being accumulated, I'm going to still stay in it. If it's a terrible base and they break, what's the worst going to happen? For the most part, it's going to be you're going to sell it to 8% or so. So that's the beauty of having stop losses. And so that's what I've learned. It's like, okay, everything doesn't have to be there. Kind of like Apple in 2004 had a RS rating of a 54, right? If you were too rigid.
And actually, if you go back and study that base, which is really worthwhile,
the Apple base,
very first Apple base, in you're honest with yourself, it's not a good base. At first glance, it's like, oh, this is a beautiful cup with handle. Do a day-by-day, week-by-week analysis on it, and just, if intellectual honesty is the most important part when you're studying historical charts or doing a post-analysis, it was the story, it was the fundamentals. The base gave you what you're talking about is an expectation. It broke out of that cup with handle. I think we were both buying it there.
And it was a powerful breakout, too.
Powerful breakout, and then built a couple base on bases. So
it was during a market correction that then it started building a tremendous relative strength, all that.
Exactly. And so, just kind of circling back to the 18-page thing, another thing to learn from is if you have rigid rules, we talked about the zone at the beginning of it, and what I would do is if I had wanted to implement those 18 pages, I would be going along, following it. And then as soon as you get in the zone, you know it because you're not looking at those rules. You're not looking at those rules. What you're doing is you're just acting. You're reacting and almost not thinking.
Yes.
And then you're in the zone and just stay in that protected at all costs because that is where you make your money. And you know it when you're not thinking. And it's you don't even have to try hard. And you buy something and it just goes up.
Yep.
And as soon as that slips and you got a couple trades that you're forcing it or you're going back and you're being super rigid on something, then you know what? You want to back away pretty fast with stuff because something is changing. It could be the market, it could just be your style is out of phase. And we all have times where our style is just in phase or completely out of phase.
Yeah, and let's talk about, let's get into what have you learned this year or this past year?
Oh, that was a really, important lesson for me. That, I went back and I had some struggles in some of my accounts and some bigger struggles. And in some other accounts, I, did very well. And what I found was that I have to trade within my personality. And it's like if you're sanding wood, you want to go with the grain. And if you're trying to fight it, like what I was talking about with Genesis in 2002, it's trying to be Bill and trying to hold on when my gut was telling me, sell it, it's not acting right. But I'm like, oh, but Bill would hold on to it, right? Be yourself. And one of the things that I've always done with my trading is I look at and I was trying to figure out a way to explain it to people.
Explain it quickly, too.
Yeah, shotgun approach. And where I trade a lot more than the 5 to 8 stocks that we always want to hone in on because 5 to 8 is the way to go. But if I'm concerned about the general market, I'm concerned about my trading, or I'm concerned about some of the stocks I'm trading, I get smaller with my position sizing. And if I'm looking at the market and saying, we're in a bull market, I want to have a lot of exposure, I'm going to spread the net out. I'm going to cast the net out. I'm going to have 20, 30, 40 stocks. And then as soon as I see which ones are working, which ones aren't, then the 40 goes to 30 real fast, goes to 20. And then before you know, I'm back down to the 5 to 8.
Yeah.
That works for me. And I was fighting against doing that. And it was causing other problems of just saying, I'm just going to be a sniper and I'm just going to buy 3 stocks or 5 stocks and I'm just going to sit with them even if they're not working. And so some people might, I know lots of people who just buy 4 stocks. They've got great stock selection. They work out. They'll sell one of them that's not working. They've got a great year. If that works for you, great. The point is, be yourself. Figure out what your edge is. And so my edge, and really thinking through it this year is totally flexible. I can sell something, buy it right back. I can watch a ton of stocks at the same time. Most people can't. So I'm going with that, and I'm using my edge versus saying I'm really weak at this particular thing. I'm going to work on 18 pages on that, rather than saying I'm really good at this. I'm going to make that a bigger aspect. And you have great stock selection.
Yeah,
well, that's your edge.
That's one thing that I've noticed. That I'm pretty decent at picking the stocks. It's just more the managing. And that. So that's the thing I have to work on. It's more the managing part, have more concept. Yeah, these are obviously the market will tell me whether I'm right or wrong. But that stock selection over the last number of years, I feel like that's definitely one of my strengths. Let's just quickly talk about routine.
Sure.
Just in 1 minute. Bill had a strict routine.
Yeah, he had a very strict routine. I looked at some of his old documents from the 60s and 70s. He actually had it mapped out per 15 minutes of the day, pretty much. Wow. At the beginning and at the end of the session. So you want to have a set routine on the weekend. Do the bulk of your work, and I think you do that too.
Yep.
Have a pre-market routine. And during the market, you pretty much just sit back and you let the information come to you. The post-market, wait an hour or two, then do a mini weekend routine. But what's your routine?
Well, what's funny, and we were speaking about this before, IBD Live actually has become part of my routine now.
What's that?
Exactly. It's going to be product placement.
Product
placement Arusha now, right? But it has now, I look forward to it every day.
Me too. It's my favorite time of the day, actually.
It's a lot of fun, or we're on the show. But I'm always looking for it. Yesterday, I didn't have access to it, so I started panicking. I was like, I need access to it, which is why you heard Scott saying, "Clear, interrupt you guys." But that has become a part of my routine, and I found that's become very helpful because I hear the team giving me news analysis, all that stuff. It saves me a ton of time. But that's a huge part. But as you said also, Mike, the weekend routine's the biggest part for me.
It's a big part.
So post-analysis is a critical exercise that you have to do at least once a year to continue to build those investing muscles. Coming up next, Mike and I are going to talk about 3 stock ideas. 4, and 1 bonus one.
I'll be fast.
We'll be back.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
We are back with Mike Webster on Investing with IBD. Okay, Mike, let's get into some current stocks. The first stock is Dexcom, ticker symbol DXCM. They're a medical device company. And they are glucose monitoring system, so they're helping people manage their diabetes, right? And so it's a huge thing because it's reducing the amount of times people have to poke themselves to do the insulin and all that kind of stuff. So huge need. Unfortunately, with our country, the diabetes is only increasing more and more. So these guys have along with a couple of other companies, right? Pod, Insulet,
Tandem.
or Tandem. Those are the 3 that are kind of innovating in this field.
And Pod looks good too. We're both trading that one.
We both trade that. I have Dexcom.
Me too.
And Mike has Dexcom. But
I have it in a contest, a Twitter contest for the year.
That's right.
This is my stock for the year. Did you join the? Okay.
Well, contest. I didn't want to jinx anything.
Well. You're a wimp, but what can I say?
I am. Yep. But so let's go to the chart here, Mike. So of Dexcom, I'm looking at it on a weekly chart here, and they just broke out of a flat base.
Yeah, so when you always want to start with a weekly or even a monthly before you go to the daily. The daily is the nitty-gritty of where you're going to buy, where you're going to add, that type of stuff. But you want to start with a weekly. Bill would spend 80, 90% of his time on a weekly. And one of the questions he'd always ask is, has this been a prior leader before? Because it can be a prior leader, then pause for a while, set back up. It could be, a group action. It could be general market. It could be something fundamental with it, because with Dexcom, they keep on coming out with a better version and better version, and then when one is really working, then it has its move.
And there's not too much competition, though, too, because I think like Insulet and Dexcom, they're working together in tandem. They're all kind of working together because they all do different aspects of it. So if I remember correctly, when I heard the Dexcom CEO a while back, he said there's not much competition right here. They really
and
have
it's a huge space, right?
Yeah.
And like you were saying, in the U.S. it's huge, and then globally.
Now eventually some of the larger medical device companies could start getting involved and all that stuff. But right now, from what I understand.
So and so going back to the good point. So going back to the chart, that it had its nice move several years back, and then it went through where it was a terrible stock, and it had that really bad break in. Was that in 17? And so that's something
it's like September 17.
Yeah, September of 17. And then you'd want to completely have it off your radar. And it came back, built base after base, a couple bases that just broke out and failed. And I think I tried some of those, and it just didn't work out. But now it's built the other base that it broke out of, and
that was on earnings. That was a breakaway gap on earnings.
Yeah, and you know a lot about breakaway gaps.
So that was perfect action right there.
And that's where we were buying. I was buying it there.
Right.
You were probably buying
it, but not enough. It was because it.
Yeah.
Obviously, looking back in hindsight, not enough, but. That was back the point where you're still like in November. It's like the market's still trying to come out. This is one of the first stocks that when I saw this one working, I was like, okay, this rally might really be starting to get legs now.
That's a very good point, because you're looking at the leaders all the time, seeing how they're acting. So it had its power from pivot, which is what that green flag is. It's saying that
28%.
28%, and within the 3 weeks, 15-day time frame. That's just a sign. You could use it with the 8-week rule, which we always do around here, meaning that you hold those shares that you bought at the pivot, for 8 weeks. It tries to get you through some of the back and forth that'll happen and some of the tricky days. But it's really just more of a sign of there could be something special here. They don't all work out, but if it's a big, quality stock like this one is, that has more of a chance of working out. Now it's let its 50-day and its 10-week line just kind of catch up to it, which is really nice. And on the weekly, it built this flat base that it's breaking out of. And so, I think it looks really good. What you have to keep in mind is that we've had this sector rotation that will happen, and sometimes, for a few days or weeks, the medicals will sell off, the chips will run up, and what have you. So you don't want to be too concentrated. So if you're trading this and pod, which we both are, you want to manage your position size appropriately. But this has the potential to be at least a year-long move or a multi-year move, but along the way it's going to be have some difficulty, as all stocks always do. But it's the other thing about this one is that I wanted to pull up was just the sponsorship, and I just before I say it, I want to make sure that I have it right, because I thought this was the largest position in T. Rowe Price New Horizon, which is one of my favorite, if not my favorite. Yeah. So if you study the T. Rowe Price New Horizon Mutual Fund, which is one of the best funds out there, and they really know their stuff, and they have 156 stocks right now, and this is their largest position, and they've been adding to it.
Wow.
So you've got the best guy out there with one of the best funds, and has it as his top position, and he's adding to it. That's the type of conviction. The way that Bill would teach us to study stocks is look at the best people and what are they doing, and the best person is their biggest position.
Incredible.
That says a lot. Doesn't mean you just blindly hold it. If this the chart starts acting funny, I'm out the door, man.
Yeah, I mean, and that's the beauty of having rules and the sell rules. You don't have to do thinking at that point.
And Contra's in there. All the good ones are in there, man.
Okay, so that's Dexcom. Let's go to the second stock, and this is Vertex. VRTX. And let me pull that up.
Now, this isn't a hot group. So the biotechs is, that's super hot. It's the number one group right now. Has a ton of stocks, over 500, probably about 550-ish. And you should play through them. And I'd sort it by, either composite rating or by relative strength and play through. And it's kind of there's a couple different segments. One, you got all the cheapies that just are junk that you just don't want to pay attention to. Low price, under $10, don't even look at it. Those stocks could be the one that goes. We had one last year that went up, more than any other stock. But the odds are just stacked against you. That's Vegas money. That's a whole different thing. That's not what we're doing here. Then you've got the big old companies like the Amgens of the world that, they have sales and they have, solid earnings, but they're kind of in a slower growth phase. And you can trade those, or you've got the hot ones that it's almost feeling like late 90s with some of the really speculative, and there's a lot of them out there. And so if you're going to trade those, the ones without earnings, those you want to have small position sizes. But this is a real company with it's in the CF space.
The cystic fibrosis, right? So
and they're the key player there.
They are the key player there, and So and this has been on our radar for a while. And it had a number of breakouts that have failed over and over and over again.
Tell the truth. Did you try any of those?
I did not try it this last time, which is why it worked.
No. Did you try any of those?
Oh, the other times, yeah.
Hell yeah.
But
they looked really good.
Yeah, I know. It's a great story. It has great numbers, but it just kept wearing me out, And so this last time it went, I was like, you're not going to get me again, Vertex. And look, and it's been trading beautifully since it. Now, I actually did buy when it pulled back the 10-week line.
Okay, perfect.
So I have some shares of it. And so now, I'm up a little bit on it. But it's just beautiful. That's the beauty of the market, right?
Yeah.
It's going to just keep fooling you, right? And you have to be, if this is one of the stocks that you really want to go for, you had to try. You have to try it again in the fall when it broke out of that consolidation.
Yeah, so I think you said it beautifully. And I had tried a bunch of them, and then I said, you know what, no more. But then this time, as I was going through the 200, I think that's where I was buying it. I still have it, and I was adding to it this past week because it was a beautiful pullback to the 10-week line. And 2 days ago, you had that nice, it was an alternative pivot, where you have a little downtrend. It broke above that. Now it broke into new highs, so it was adding a little bit at each of those times. And this has the potential of being a big long-term mover. Now with biotechs though, you can get some FDA blindside, so you can't have a big position in it, no matter what, because you never know. It might not be with this stock; it could be with new competition or something. So you want to size it appropriately. But going to the weekly chart on this, look at all those weeks up in a row.
It's beautiful. Yeah.
That's a sign of some serious accumulation. And then going to the sponsorship, they've got Contra in there, adding to it as one of their bigger positions. You've got MFS growth in there. They're really good. They've been reducing it, but a lot of good players. Wells Fargo growth. They're a really good fund, and so. I think it looks very interesting, and especially since they're the number one in their space, strong estimates. Yeah, looks good.
Let's go to the third stock, and this is an oldie but goodie, Nvidia.
Nvidia, but you didn't tell me we were going to talk. Yeah. So look, Nvidia, that's a clear model book stock from its prior run that it had from the $30 price range back in 2016, ran up, and then it was a classic kind of model book stock that it topped and went through a big correction, I think 50-something%. But it was able to, stabilize. And I think that there were some problems with, they're in the self-driving chips, but they're also in the data mining for the gaming, and then the Bitcoin. And I think probably the Bitcoin thing is what might have started that snowball. So it's coming back, and it has wonderful sponsorship. Pull it up, and you can look. All the best people are in there. And those estimates going forward are very strong, and they've been beating their estimates, so those are most likely low. And even though it still has some overhead to work through, that overhead resistance is back in time kind of far enough that you don't have to be as concerned with it. And it just had 3 weeks tight, and I'm trading this, been adding to it. It looks like if it can go through the 241.81, which is the recent high, we'll be adding to. I'll be adding to it more. How about you? Are you trading this?
I just started buying it off the 3 weeks type because when it was coming out that cup with handle and shortly afterwards, it just didn't. These are the types of setups that I just don't do as well at. So I passed on it because it got hit that 50%, as you said.
Yeah.
So I passed on it, but now it's setting up again. So I bought a little bit because it's a 3 weeks tight. It's not a normal base, so you don't go in as heavy on that. But yeah, I finally got some shares of this.
Yeah, and so it looks really good. Now it does have some problems with it. The sales growth and the earnings are still negative for the most recent quarters, but the estimates going forward are very strong. So it's not for everybody. And I was trading it, back, several, a couple quarters ago when it was, coming out of this stuff and got kicked around a little bit, because I didn't have a lot of confidence because it had overhead resistance. And it's very rare for us to trade stocks with an overhead resistance. But, it is kind of a special situation. And, it's a big cap, great sponsorship, great story, great CEO, great product.
They have to have a lot of things going for it. And, so keep it on the watch list. Remember, a 3 weeks tight isn't a base, so that's where you just add a sprinkle on shares, as I like to say. Yeah. So it's not a lot of shares.
You sprinkle, I nibble.
Okay, perfect. Yes. So keep that in mind. It'll set up again. They're going to report. They're going to report in another 35 days or so. So we'll have to wait and see how earnings season treats all these stocks.
Yeah.
Which it's coming up pretty soon. So everyone needs to be aware of that. So let's go to one more stock, the bonus stock.
The bonus.
The bonus stock.
Okay, this stock. Do not buy this stock here. This stock is extended. What stock is this?
This is a stock called Tesla that everyone gave up on, including me.
Well, look, this is a stock that divides people as much as politics divides people. So there's people who just hate it, people who love it. I'm in the love camp.
I love Elon Musk. I've always been. I think what he's doing is amazing, which is why, for me, I'm all over Tesla once it gets going. And this time, I don't know. I just missed it. Yeah.
Well, I think he's pretty much the smartest man, one of the smartest men who've ever lived, or human beings, I should say. Right up there with, Edison and Steve Jobs, and a completely different type of individual. And so when this gapped up on those earnings, I very rarely trade in after hours, or it must have been after hours, not pre-market. And, I started buying there in my personal because this is a very unique situation. This is one where the shorts just hate Elon. They think he's a fraud. They think that, you see all the videos of, the Tesla cars, on fire. Right. They don't talk about the other 30,000 cars that go on fire all the time. So it's a very unique situation. That the shorts are in there, and anything good is going to squeeze them. So I started buying it there. I thought it was forming an ascending base because if you look at it, it had this powerful move up, came in and looked very much like it did out of its original move. If you go back several years, you could study that. Came back in, found support on the 21-day moving average, moved up through that at the 362 type of area, and it looked like it was going to form an ascending base where we had one pullback, then two pullbacks, and then it just kept getting stronger and stronger. And I think it's just the shorts getting squeezed. Now it's gotten out of hand. Now I still have it, and it's my biggest position, but I am positioning myself for some pain because things don't get this easy, and especially with a stock like this. So I'm going to be watching this for the rest of the year, and it's going to be a bumpy ride. I'm not putting it on autopilot. That was a joke. You didn't touch it. That's fine. It was really funny in my head. So the best case scenario is if we could just go sideways here underneath 500 and form kind of like a high tight flaggish type of thing, then hit it hard there. But if you're in it, I'd say buckle up. And if you're not in it, watch it and wait for a proper entry, because I think there's a huge potential besides just a short squeeze. They've got the China stuff going on. They've got the Cybertruck, which is the most beautiful thing that's ever been created or invented. in all of time. And then they've got all the other great stuff that you love, right?
Yeah, so you make sure you plug that idea into your watch list.
Oh, yeah, I see you trying to. That was good. Yeah. Not as good as mine.
So there are 4 ideas to consider. Thanks, Mike, for joining us today.
Thank you.
That's it for this week on Investing with IBD. Next week, we are going to have Jeffrey Hirsch. He is the CEO and editor-in-chief of the Stock Traders Almanac.
Oh, wow.
Yeah, isn't that
Dude,
cool? Yeah.
That's awesome. I love that book.
I know, me too. So we're going to talk about how stocks generally perform in the upcoming election cycle.
Cool.
So that's it. I'm Arusha Paris, and thanks for listening.